In the summer of 1845, the air in London did not just smell like coal and horse manure, it smelled like greed. If you walked into a coffee house on Change Alley, you would not hear talk of politics or the weather. You would hear one word, repeated like a mantra: railways. People were quitting their jobs. Clergymen were emptying their tithe boxes. Widows were betting their life savings on companies that did not own a single locomotive. They were buying the future. They were buying speed. They were buying the death of distance. Fast forward 181 years. The year is 2026. The boardroom of every Fortune 500 company sounds exactly like those London coffee houses, but the word has changed. Now, it is generative AI. Over $200 billion has been poured into compute, the digital tracks of our era. We are told this is a new paradigm. We are told that productivity will explode, but here is a haunting echo from history. In 1845, they said the exact same thing about the iron rail. And while they were right about the technology, they were catastrophically wrong about the money. Welcome to the money echoes. Today, we look at the ghost tracks. Why AI's $200 billion gamble is a rhyme from the 18. To understand why we are currently obsessed with AI data centers, we have to understand a concept called general-purpose technology. Every century or so, humanity discovers a tool that changes everything, not just one industry, but the very fabric of how we move, think, and trade. In the early 80s, that tool's the steam engine. Before the train, the fastest a human could travel was the speed of a galloping horse. That was the hard limit of the global economy for 3,000 years. Then, suddenly, we broke the limit. The first railway, the Liverpool and Manchester, was a gold mine. It proved that if you could move goods and people faster, you could essentially print money. This was the proof of concept. Just like the release of ChatGPT in late 2022 was the proof of concept for AI. It proved the tech worked, and that is when the madness started. Enter the influencers of the 1840s, men like George Hudson. He was the Sam Altman of his day. Hudson told the public that the old rules of economics were dead. He promised that every village in England needed a railway station, just as today's tech gurus say every app needs a large language model. By 1845, the British Parliament had authorised over 9,000 miles of track. To put that in perspective, that is enough to wrap around the coast of Britain 3 times over. The problem? Most of these lines were ghost tracks. They connected point A to nowhere, but the investors did not care. They were not buying the utility of the train, they were buying the momentum of the stock. Sound familiar? In 2026, we see the hyperscalers, Microsoft, Google, Meta, building gigawatt-scale data centers. These are massive $5 billion concrete fortresses designed to house AI chips. We are building the tracks for an AI revolution at a pace that assumes the demand will be infinite. But as we sit here in 2026, the killer app for AI, the one that justifies $200 billion in electricity and silicon, is still surprisingly hard to find for the average person. We have the tracks, but where are the passengers? History tells us that the Railway Mania did not end with a whimper, it ended with a scream. By 1847, the Bank of England had to raise interest rates to protect its gold reserves. Suddenly, the easy money that fueled the railway boom evaporated. Families who had leveraged their homes to buy railway shares realized those shares were now worth less than the paper they were printed on. George Hudson, the railway king, was exposed as a fraud who had been paying dividends out of new capital, a classic Ponzi scheme, before the word Ponzi even existed. Railway stocks dropped 85% in value. This is the part of the echo that terrifies Wall Street today. If central banks keep rates higher for longer in 2026, the astronomical burn rate of AI companies becomes a death sentence. When the cost of capital goes up, the ghost tracks start to look like very expensive tombstones. But here is the twist. Here is the part of the story that the doomers and the optimists both miss. Even though the investors were wiped out, the tracks remained. The physical infrastructure, the tunnels, the bridges, the embankments, it did not disappear just because the stock price did. In the 1850s and 1860s, Britain entered its greatest era of economic growth. Why? Because it had a surplus of cheap, overbuilt infrastructure. Because the ghost tracks were already there, the cost of moving goods dropped to near zero. The failure of the Railway Mania actually subsidized the success of the Industrial Revolution. Now, look at 2026. If the AI bubble bursts tomorrow, if Nvidia's stock craters and startups vanish, the data centers will still be there. The subsea fiber optic cables will still be there. The massive power grids we are building today will be the ghost tracks of the 21st century. This brings us to the most important lesson for your wealth in 2026. History teaches us that the people who build the infrastructure usually get wiped out. The people who use the overbuilt, cheap infrastructure 10 years later are the ones who become billionaires. In the 1840s, the builders were the railway shareholders. Most lost everything. In the 1860s, the users were the industrialists and global traders. They became the new elite. In the 1990s, the builders were fiber optic companies like WorldCom. They went bankrupt. In the 2010, the users were Netflix, Amazon, and Google. They became the trillion-dollar winners. We are currently in the builder phase. We are laying the iron. We are arguing over whether an AI can write a poem or pass a bar exam. But the real money echo is not about the software. It is about the stranded assets. If you are an investor today, you have to ask yourself, am I buying the mania or am I waiting for the utility? The real fortunes of the AI era will not be made by the people selling the chips. History says their margins eventually collapse. The fortunes will be made by the companies that use this massive overbuilt compute to solve problems we have not even named yet. History does not repeat itself, but it does rhyme. In 1845, they thought the train was a toy for the rich. They were wrong. It was the skeleton of a new world. In 2026, we are building the skeleton of a digital mind. Many will lose their shirts. The mania will end just as it did in 1847. But when the dust settles, we will find ourselves standing on a planet wired for intelligence. Do not watch the stock ticker, watch the tracks, because the echo tells us that the greatest wealth is not in the building, it is in the aftermath. History does not just repeat, it rhymes. So make sure you are listening for the next Money Echoes. Subscribe, and I will see you in the next one.